To talk about your money and how this impacts your 401ks or portfolios if you have one. With certain U.S. companies making up a larger percentage of major market indexes, there is growing concern on what's called concentration risk. What is that? Joining us to explain is financial expert Marshall Clay with the Wealth Group. Good to see you this morning.
Hey, good to see you.
All right, so first of all, explain what that is.
So I think our viewers probably intuitively get not putting all of your eggs in one basket,
Sure.
that old saying. And I think as investors, it's easy to understand to not put all your money in one company or one sector.
Okay.
And these broader market indexes are starting to sort of resemble some of this risk, right? So what I mean by that, if you take the S&P 500, for example, the top 10 companies in that index now make up 38% of the entire S&P 500.
And which sector are they in?
Well, and eight of those 10 are in one sector, the technology sector.
See, so if tech goes down, that could really hit you hard if you're mostly in tech, right?
Correct. And
Yeah.
so if you had a bunch of other, investments in other areas, of the economy, and tech is going down, the broader market indices could be a lot more violent to the downside.
Interesting. So if somebody has a 401k or portfolio, should they be concerned by what they're seeing right now?
Well, I'd say concentration risk is not necessarily bad. I think it depends on your time horizon. If you're a younger investor, if you're in your 20s or 30s, I think you can take a little bit more of a flyer on individual companies or being overweighted into a sector like technology, because technology does offer probably the most growth relative to any other sector.
Okay.
But if you're closer to retirement, if you're 5 or 10 years, out of retirement, you've got to understand that with that greater upside potential that comes with concentration also comes greater downside risk. And so if you're in that window where you're looking to retire and you're about to become reliant on this portfolio for cash flow, you want to be a little bit more conservative and a little bit more understanding of the risk that you're taking.
So it sounds like the good advice here is, first of all, do some homework if you're doing this on your own, and if you're not, get with your advisor and ask them these questions.
Absolutely. I think the big takeaway here is do not assume that when you put money into these broader market exchange traded funds or mutual funds that sort of profess to have diversification across 500 companies, that may not actually be the case. There's a lot more market concentration built into these ETFs, mutual funds, than meets the eye. And so doing your homework, looking inside your 401k, looking at the different investment options. Unfortunately, a lot of 401k programs have become very cookie cutter and they limit the amount of investment options.
Yes.
But whatever investment options you have, take a really long, hard look at these options to make sure that you're diversified within those ETF and mutual funds.
So look in there, and if it says in your thing, there's all tech companies or whatever, that could be an issue. Make
Perfect
sure
example. Yeah, it's easy to kind of click on them and you can look at the top 10 and see their weightings and just make sure that you're taking the appropriate amount of risk for your station in life.
All right, some good things to think about. Marshall Clay, well, appreciate it.
Appreciate you.